Hey guys, welcome back to Module 15. We're going to be talking about sort of defining cost, types of behavior, estimation of cost. Ultimately, what does it cost isn't as simple as it sounds. So, in Chapter 14, we made the transition from financial accounting to managerial accounting. We said that managerial accounting is ultimately about providing managers with the information they need to make decisions. But in this chapter, we're going to focus on one of the most important pieces of that information, and it's cost. So at first, cost seems straightforward. A manager asks, what does this product cost? And accounting gives us a number. But managerial accounting requires us to ask much more specific questions, like what kind of cost? Does the cost change when activity changes? Can we trace the cost directly to a product or service? Will the cost disappear if we stop doing something? And which costs actually matter for the decision we're trying to make? Those kind of distinctions become really important in the chapters that follow. So, how long, really looking at how long or how will our costs behave when the business changes? And part of that depends on the question. The One of the first ideas I want you to understand is that there isn't necessarily one universally correct cost number for every managerial purpose. The useful cost depends on the decision being made. Suppose you manage a manufacturing company and someone asks, what does it cost to produce this product? Do they mean the materials used to manufacture it, the labor, the factory rent, the utilities, equipment depreciation, corporate headquarters, marketing? The answer really depends on why we're calculating that cost. So they aren't competing definitions, but managerial accounting contains different cost classifications. There are different ways of organizing information for different managerial purposes. For example, variable costs. This is one of the most important classifications in cost behavior. So a variable cost changes in total as the level of activity changes. Suppose a company uses $5 of material for every unit it produces. If we produce one unit, the total material cost is $5. But if we produce 1,000 units, the total material cost is $5,000. If we produce 10,000 units, it's $50,000. So total variable costs change with activity. But notice something important. The variable cost per unit remains constant at $5. That's the relationship I want you to remember. As activity increases, total variable cost changes, but variable cost per unit remains constant, assuming we're operating within the relevant range. So from a manager's perspective, more sales don't mean every cost goes up. Suppose sales increase 20%. Would you expect every company cost to increase 20%? Answer is no. Some costs may increase roughly with activity, while others may barely change at all. That's why managers need to understand cost behavior, because rather than simply looking at last year's total costs and assuming they'll move proportionately with sales, so look at fixed cost, like a rent. You pay the same amount of rent every month. So it doesn't matter if you produce 1,000,000 units or 5 units, you still have to pay rent. A fixed cost remains constant until as activity changes, again within the relevant range. Suppose the company pays $100,000 a year in rent. Whether we produce 10,000, 20,000 units, the total rent is going to be $100,000. Look at it on the cost per unit. If we produce 10,000 units, 100,000 divided by 10,000 equals $10 rent per unit. If we produce 20,000 units, 100,000 divided by 20,000 means $5 rent per unit. So fixed costs have almost the opposite, behave oppositely than variable costs. For a fixed cost, the total cost remains constant, but fixed cost per unit changes as activity changes. And that distinction becomes extremely important when managers evaluate profitability and pricing. So from the manager's lens again, sort of the danger of fixed cost per unit. Suppose someone tells you our fixed manufacturing cost is $10 per unit. Be careful. That isn't really a fixed amount per unit, it's an allocation on a particular level of activity. If the production changes, the fixed cost per unit changes. That's one reason managers can make poor decisions when they treat allocated fixed costs as though they behave the same way as variable costs. And we'll see the consequences of that mistake, especially in chapter 17. So for the relevant range, you may have noticed that I keep saying within the relevant range, and that's an important qualification. The relevant range is the range of activity within which our assumptions about cost behavior are expected to remain reasonably valid. Suppose your current facility can produce up to 100,000 units. Within that range, factory rent may be fixed, but what happens if demand increases to 150,000 units? You may need another facility. Suddenly rent increases. So saying rent is fixed doesn't mean rent will remain unchanged forever regardless of activity. It means we expect to remain fixed within a specific operating range. That's more realistic. We talk about mixed cost. So not every cost is purely variable and purely fixed. Some costs are mixed costs. Mixed costs contain both a fixed component and a variable component. Think about a utility bill. A business may pay a basic monthly charge regardless of usage, but it pays additional amounts based on how much electricity it consumes. Conceptually, we can express a mixed cost as total cost equals fixed cost plus variable cost, or using the equation in managerial accounting, y equals a plus bx, where y is the total cost, a is the fixed component, b is the variable cost unit of activity, and x is the level of activity. So why do managers care? Because if we can estimate the fixed and variable components, we can begin predicting what costs should look like at different activity levels. And that's exactly what we will need for planning. So, of course, real world costs don't always arrive nearly neatly labeled. So I'm a 60% fixed and 40% variable cost. Managers have to estimate cost behavior from data. The chapter will introduce several approaches, including the scatter graph analysis, the high-low method, and the least squares regression. The purpose of all three is essentially the same: use historical information to estimate the relationship between activity and cost. When we talk about scatter plots, it's a useful starting point. We plot the activity on an axis and cost on the other. Then we look for a relationship. If cost generally increases as activity increases, the graph can help us visualize that relationship. But scatter plots do something else that's extremely unusual or useful. They can help reveal some unusual observations. Suppose 1 month's cost is dramatically different from every other month. Maybe there was a shutdown, maybe equipment failed, maybe an unusual event occurred. A manager shouldn't automatically feed the number into a forecast without understanding it. So visualizing the data can be surprisingly valuable. Also, the high-low method. Chapter will introduce the high-low method, and the idea is pretty straightforward. We identify the highest and lowest activity levels and use the change in cost relative to the change in activity to estimate the variable cost per unit. Then we use that information to estimate the fixed component. One point I'd like to emphasize is we use the highest and lowest activity, not necessarily the highest and lowest total cost. Okay, so it's on the activity, not the total cost. The high-low method is easy to use, but it has a major limitation. We're estimating cost behavior using only 2 observations. That means 2 observations may not represent the full relationship particularly well. So high-low is useful, but it's not necessarily our most sophisticated model. We talk about regression. This is a more statistically supported approach, is least squares regression. Rather than relying only on 2 different observations, regression uses the available data to estimate the cost relationship. You don't need to become statisticians for this course, but what I want you to understand is the managerial advantage. Suppose I have 2 years of monthly costs and activity data. High-low uses 2 observation, and regression can use the broader data set. That can give us a better a basis for estimating the fixed component, the variable component, and the strength of the relationship between cost and activity. But there's also an important caution. The spreadsheet isn't the manager. Suppose Excel gives you a beautiful regression equation. And does that automatically mean you have a good cost estimate? No. You still need to ask, does the relationship make economic sense? Did something unusual happen in the historical period? Is activity really causing the cost? Will the historical relationship continue in the future? And that connects directly to chapter 12. So a really sophisticated model doesn't eliminate the need for managerial judgment, but the spreadsheet can calculate the relationship. The manager has to determine whether the relationship is meaningful, though. When we talk about direct and indirect cost, direct cost can be economically traced to a particular cost object. Cost object could be a product, a service, a department, a customer, or a project. For example, the wood used to manufacture a specific piece of furniture can usually be traced directly to that product. An indirect cost cannot be conveniently or economically traced to one particular cost object. So factory rent is a good example. The facility may support thousands of products, and we can allocate the rent across the departments, but that doesn't mean the rent was directly caused by any one unit. The distinction matters because allocated costs and avoidable costs are not necessarily the same thing. That's going to be extremely important when we reach chapter 17. So looking at it from a manager's lens, don't confuse allocation with cause. Suppose that your accounting system assigns $50,000 of corporate overhead to one product line. Does that mean the company will save $50,000 if it eliminates that product? Not necessarily. If the corporate office will remain open and those employees will remain employed, the $50,000 may simply be reallocated to the remaining products. And this is why managers need to understand what costs actually change because of a decision. So the accounting allocation may be useful for one purpose, but it may be misleading for another. So why cost behavior matters? Let's bring it all together. Why are we spending an entire chapter distinguishing fixed, variable, mixed, direct, and indirect costs? It's because managers constantly ask what if questions. What happens if sales increase? What happens if production falls? What happens if we add another location? What happens if we eliminate a product? What happens if we outsource an activity? Or what happens if we reduce our selling price? To answer those questions, we need to know which costs will change, by how much, and which costs will remain. That's the foundation of our managerial accounting work. So in looking back over chapter 15, it is important that you understand the appropriate definition of cost depends on managerial purpose. So different decisions require different cost information. Second, you need to understand variable cost. Total variable cost changes within activity, while variable cost per unit generally remains constant within the relevant range. But fixed costs generally remain constant within the relevant range, while fixed cost per unit changes as activity changes. So you also need to understand the importance of the relevant range, that cost behavior assumptions don't necessarily remain at every possible level of activity. And for mixed cost, that basic equation of y equals a plus bx is important. We also need to understand why managers use scatter graphs, high-low analysis, and regression to estimate cost behavior and recognize the limitation of these methods. We also need to understand the difference between direct and indirect costs, and especially remember an allocated cost is not necessarily a cost that will disappear if we change a decision. So the manager's lens takeaway that I want from this chapter is if our level of activity or our business decisions change, which costs will actually change and which will not. Once we understand that, we can begin doing something extremely powerful within the world of managerial accounting. So we can predict how changes in sales volumes, selling prices, variable costs, and fixed costs will affect the profits. And that's exactly where we're headed with Chapter 16 and the cost volume profit analysis, otherwise known as CVP.